Everyone wants to know the number. The one that shows up in headlines. $1 billion under management, a fund that closes with institutional checks the size of small countries' GDP. Nobody wants to talk about the number that actually starts it. Zero. Not a soft zero either. The kind of zero where you don't have a track record, don't have a warm Rolodex of pension fund CIOs, don't have a single wired dollar sitting in an entity that legally exists yet. You have a thesis in a notes app and a spreadsheet with formulas you built at 1 a.m. that nobody has checked but you. This is level 0, the founder phase. The part nobody photographs because there's nothing to photograph yet. No ribbon cutting, no press release, no LP logo wall. Just you, a laptop, and the particular kind of exhaustion that comes from being both the analyst and the person who has to convince someone, anyone, that you know what you're doing. You start the way almost every fund manager who's ever raised real institutional capital started, with paperwork nobody finds glamorous. You form the entity. An LLC for the management company, a separate GP entity for the fund itself, sometimes a third structure if you're already thinking about carry allocation down the road. It costs you maybe $800 to $2,500 depending on which state you file in and whether you pay a securities attorney to do it right or you cobble it together yourself off a template you found and prayed was current. You pick Delaware for the fund entity because everyone tells you to, and you pick your home state for the management company because that's where you actually live and work, and you learn fast that these decisions matter more than they look like they should on the surface. Then comes the decision that actually determines whether anyone ever takes you seriously, your niche. In 2026, capital isn't chasing everything anymore. Rates came down off their highs, but not far enough to make cap rate compression the free lunch it was in 2019. Multifamily got crowded years ago. Every MBA with a deck calls himself a multifamily sponsor now. Industrial still has legs, but the good deals get bid up before they hit a broker's email blast. Distressed is where the real opportunity sits, but distressed requires operational chops most first-time sponsors don't have yet. So you pick. Not everything. One thing. Maybe it's workforce housing in a secondary Sunbelt market nobody's paying attention to. Maybe it's small bay industrial in a logistics corridor. The niche isn't a preference, it's a positioning statement. It's the sentence you'll say 100 times over the next 3 years until you're sick of hearing your own voice say it. Here's the part that actually humbles you. You need capital for your first deal, and no institution on earth is giving it to you. Not a family office, not a pension allocator, not even a small regional bank without serious hesitation. So you go where every fund that now manages billions once went, friends and family. You raise $150,000 from your old college roommate who did well in tech. Another $75,000 from an uncle who made money in a business that has nothing to do with real estate but trusts you specifically, not the deal. Maybe $40,000 from your own savings, money you probably shouldn't be risking but do anyway because conviction without skin in the game convinces nobody, least of all yourself. You end up with somewhere between $250,000 and $600,000 in committed capital. Not a fund, not yet, a syndication, one deal, one property. Maybe a 12-unit value-add multifamily asset for $1.4 million, or a single small industrial building for $900,000, something sized exactly to what you can actually raise and exactly to what you can actually manage without a team. And here's the truth almost nobody tells you at this stage. That first deal was never about the money. If it returns 14% instead of the 18% you projected, it doesn't sink you. What sinks you is if you can't execute. If the renovation runs over budget by 40% and you don't communicate it. If the property management goes sideways and you find out from a tenant complaint instead of your own systems. Your first deal is a live audition, except the judges are the same people whose money you'll need to raise your next, larger deal and the deal after that, and eventually the $10 million check from a family office who heard about you through someone who heard about you through your uncle. You're building something invisible during this phase, something that doesn't show up on a balance sheet at all, your track record. Not returns, execution. Did you do what you said you'd do on the timeline you said you'd do it? Communicating clearly when things went wrong. That's the actual product you're selling at level 0, long before you're selling square footage or cap rate arbitrage or market thesis. You're selling the fact that you are, provably, someone who can be trusted with other people's money and not blow it up. Alongside that first deal, you're doing something else almost nobody notices you doing, writing the story. Not marketing copy, the actual thesis. Why this niche? Why this market? Why now? Why you specifically instead of the 100 other people who could theoretically do the same thing? You're refining that story every single time you tell it, at every coffee meeting, every cold email that actually gets a reply, every skeptical question from your uncle's friend who wants to know why you're not just buying an index fund instead. That story, sharpened over dozens of rejections, is the exact thing that turns into your pitch deck 18 months from now when you're raising your first real fund instead of a one-off syndication. Right now, you don't have LPs. You have believers who happen to be related to you or drink beer with you on weekends. You don't have a fund. You have a deal. You don't have a track record. You have a bet nobody's graded yet. But somewhere in that 12-unit building, in that spreadsheet, in that thesis you've now said out loud enough times to believe it yourself, the actual fund, the one that will eventually manage real institutional capital, is already being built. You just can't see it yet. Neither can anyone else. That's exactly the problem you're about to spend the next several years solving. That first deal closes, and something shifts that you didn't expect. It's not the money. The $600,000 syndication returns 16% net to your investors over 22 months, which is good, not legendary, but good enough that your uncle calls you unprompted to ask if you're doing another one. That phone call is the actual unlock, not the return. The fact that someone who trusted you with money is now asking to trust you with more of it before you even pitched him. This is level 1, somewhere between $1 million and $25 million in assets under management, and the entire game changes shape underneath you. You're not doing one-off deals with a handshake and a spreadsheet anymore. You're building an actual fund, which means you're building an actual structure, and structure is where most first-time sponsors quietly fall apart before anyone outside their circle ever hears their name. You form your first real fund vehicle, a GP entity that you and maybe one partner control, an LP entity that outside capital flows into, and a set of terms you have to actually defend now instead of just describe. A 2% management fee on committed capital, sometimes 1.5% if you're being aggressive about winning your first outside checks. An 80-20 split above a preferred return, usually 7% or 8% in 2026's rate environment, because with the Fed holding rates higher than the 2010s crowd ever got comfortable with, LPs expect their preferred return to at least gesture at what a boring bond ladder pays them. You build a waterfall for the first time in your life. Return of capital first, then the preferred return, then a catch-up tranche, then the 80-20 split on everything after that. You didn't know what a catch-up tranche was 8 months ago. Now you're explaining it, slowly, to a dentist in his living room while his wife pours you both coffee you don't really want. That dentist is your first real outside LP, and he matters more than any billboard or paid ad campaign ever could. Nobody at this level is raising money from strangers on the internet. You're raising it from people who know somebody who knows you. A local business owner who's watched your first project get built from the road every day on his commute. A small family office 2 towns over that manages maybe $40 million total and writes a $250,000 check into your fund because the principal's brother-in-law vouched for you at a dinner. High net worth individuals who aren't ultra wealthy, doctors, dentists, business owners sitting on $500,000 to $2 million in investable assets, looking for something that isn't the stock market and isn't a mattress full of cash either. You're not marketing, you're not running ads, you're having the same 17 conversations over and over with slightly different people, and reputation is doing all the heavy lifting marketing would do at a bigger fund, because at $8 million in AUM, nobody diligences you off a website. They diligence you off whether the last guy you worked with still takes your calls. This is also exactly where the mistakes start showing up, and they're rarely dramatic. Nobody blows up spectacularly at level 1. They erode quietly. The most common one is overpromising. You get excited on a call, you say something like conservatively 18%, and 6 months later, when the market softens or a contractor runs late, that number sits in someone's memory as a promise instead of a projection, and you spend the next year managing a relationship instead of a deal. The second mistake, the one that actually kills funds this size, is underestimating capital calls. You raise $4 million in commitments but only call $1.2 million up front, thinking you're being considerate, and then a renovation budget balloons or a second acquisition closes faster than planned, and suddenly you're calling capital on 30 days' notice from a dentist who genuinely does not have $180,000 sitting liquid. He's good for it eventually, but that phone call, the one where you have to ask sooner than promised, is the one that determines whether he ever writes you a second check. So you start building the boring stuff, the stuff nobody brags about at a conference, but every fund that survives past this level has quietly nailed down. Quarterly reporting that actually goes out on time, even when the news inside it is mediocre. A basic compliance framework, usually a Reg D 506B or 506C exemption, depending on whether you're taking accredited investors you already know or opening it slightly wider. With a securities attorney, you're now paying real retainer money to instead of a flat one-time fee. Fund administration, even a lightweight version of it, because the day you have 11 LPs instead of 3, you cannot be the one manually tracking capital accounts in a spreadsheet with formulas only you understand. You bring in a part-time fund administrator, maybe $1,500 a month, just to keep the K1s clean and the capital account statements accurate, because the first time an LP's accountant catches an error in your numbers is the last time that LP's accountant lets him invest with you again. None of this feels like leveling up while you're inside it. It feels like paperwork, like phone calls you don't want to make, like explaining a waterfall for the 9th time to someone who nods but clearly still doesn't fully get it. But somewhere in year 3, it happens. Your first real fund completes a full cycle. You acquire, you execute the business plan, you exit, and you return capital plus a strong net return, something in the 15% to 20% IRR range that actually beats what you told people to expect instead of falling short of it. That's the moment the level actually breaks open, not the AUM number, not the size of the checks. A completed cycle, audited, documented, provable, sitting behind you as evidence instead of projection. That's the thing you carry into the next room, the one with bigger allocators in it, the one where nobody's going to take your word for it anymore. They're going to want the paperwork. The next room is nothing like the dentist's living room. There's no coffee you don't really want. There's a conference table, 6 people around it, and a binder in front of each of them thicker than anything you've ever produced in your life. This is level 2, somewhere between $25 million and $250 million in assets under management, and the first thing you learn walking in is that the completed cycle that felt like proof to you is barely the opening question to them. You're in front of a public pension allocator or an insurance company's real estate arm or a university endowment's alternative investments desk, and the person across from you doesn't care that your uncle called you unprompted. They've never met your uncle. They manage $4 billion across 200 fund relationships, and they have a risk committee that meets on Thursdays whose entire job is finding reasons to say no. Institutional capital doesn't invest in you. It invests in a system that happens to have your name attached to it, and if that system doesn't exist yet, the meeting is over before the coffee gets cold, and this time nobody's pouring it for you. This is where audited financials stop being a nice-to-have and become the price of entry. Not reviewed financials, not internally prepared statements with a CPA's name stamped on the cover for comfort. Audited, full GAAP compliance, a Big Four or at least a respected regional firm signing off on every fund vintage you've ever raised. You pay for this now. Real money, $60,000 to $150,000 a year, depending on fund complexity, and you pay it whether or not you raised a single new dollar that year, because the audit isn't for your investors anymore. It's for the investors you don't have yet. Sitting in a data room, they'll never let you watch them read. The team changes shape underneath you the same way the fund structure did back at level 1, except now the stakes have zeros you're not used to attaching to a salary line. You hire a real CFO, not a bookkeeper wearing a bigger title, someone who's closed institutional rounds before and knows what a risk committee's questions actually mean underneath the words they're using. You bring in dedicated asset managers, one person per few hundred million, instead of you personally walking every property twice a month like you did when the whole portfolio fit in your car's GPS history. You build an investor relations function for the first time, a person or a small team whose entire job is managing the reporting cadence, the quarterly calls, the annual meeting institutions expect to fly you out for, because at this size, relationship management isn't something you squeeze in between deals anymore. It is the deal running in the background permanently. Due diligence at this level stops feeling like a conversation and starts feeling like an audit of your entire life. Site visits from analysts who fly in specifically to inspect 3 properties out of your 40 and extrapolate your operational discipline from what they find in those 3. Reference calls to LPs from your level 1 fund, the dentist, the family office 2 towns over, except now they're being asked structured questions off a checklist by someone who's never met them and doesn't care whether they liked you personally, only whether you called capital on time and reported accurately when the news was bad. Legal review that goes through your fund docs line by line looking for GP favorable terms that would have sailed past a doctor writing a $250,000 check but get flagged immediately by an institutional counsel whose only job that week is finding them. You survive this not by being flawless. You survive it by having nothing to hide and paperwork clean enough that hiding was never an option anyone considered. The capital itself behaves differently once it lands too. A pension fund or an insurance company isn't writing you a $250,000 check like your first dentist did. They're committing $10 million, $25 million, sometimes $50 million in a single allocation, and that check comes with covenants, reporting requirements, and sometimes a seat or an observer right on decisions your GP entity used to make alone in a room with one other person. Leverage changes shape alongside it. You're no longer stretching to get a local bank to underwrite a $2 million bridge loan on your second deal. You're working with institutional lenders, agency debt through Fannie and Freddie on stabilized multifamily, CMBS conduits, insurance company balance sheet loans at rates that in 2026's environment still sting more than the 2010s crowd ever had to budget for, but at leverage ratios and loan sizes that let a single deal now move $40 million or $80 million instead of $2 million, because the equity check got bigger and the debt markets that serve funds this size were built for exactly this scale. You're also not running one fund anymore. You're running vintages, Fund 2 sitting alongside Fund 3, each with its own capital account, its own investors, its own J-curve, and you're diversifying property types for the first time out of strategy instead of opportunity, multifamily alongside industrial, alongside a small allocation to self-storage or medical office, because institutional allocators want to see that your returns aren't a single bet that happened to work. They want to see a repeatable process across asset classes that proves the edge is you and your team, not the market cycle you happen to catch on your first deal. And quietly, underneath all of it, you start setting up relationships that don't pay off yet, but will matter enormously at the next level. Fund of funds managers who allocate to emerging managers like you as a category, writing you into a diversified vehicle alongside a dozen other sponsors your size, giving you your first taste of capital that comes from an allocator who's never going to take your personal call, only your quarterly report. Co-investment relationships with larger sponsors where you bring the deal and they bring an additional check alongside your fund's capital, letting you punch above your fund's actual size on individual acquisitions without diluting your own investors' allocation. None of this feels like leveling up while you're living inside it, same as before. It feels like paperwork that costs 6 figures a year, meetings with people who ask better questions than you have answers for, and a team payroll that makes you check the bank balance more nervously than you did when it was just you and a spreadsheet. But somewhere in this range, usually once you cross $100 million with 2 completed institutional-grade audits behind you, something shifts again. The phone calls stop being you chasing allocators. They start being allocators calling you, asking if Fund IV has room, because the paperwork you built out of pure necessity became the actual product they were buying all along. The room after this one doesn't have a conference table anymore. It has a floor. An entire floor of a building with your firm's name etched into glass at the elevator bank, and somewhere around $250 million you stop being a fund and start being what the industry quietly calls a platform, which is a polite way of saying you now run several businesses wearing one logo. This is level 3, the stretch between $250 million and $1 billion, and the first thing that changes is the question itself. Nobody at this size asks if you can raise a fund. They ask what your platform covers. You're not pitching Fund 3 anymore, you're pitching a value-add multifamily strategy, an opportunistic industrial strategy, maybe a credit fund sitting alongside the equity funds, all running concurrently, each with its own investment committee, its own waterfall, its own capital calls landing on different Tuesdays. You used to manage one J-curve, now you're managing 4 or 5 at once, staggered across vintages, and the spreadsheet that tracked this used to fit on your laptop now needs its own dedicated systems team just to keep the numbers from bleeding into each other. The capital itself changes character again, too. This is where sovereign wealth funds start showing up in the data room, allocators from Abu Dhabi or Singapore or Norway who manage more money than most countries' GDP, writing $75 million or $150 million checks, not because they love your deck, but because you've become large enough and clean enough to absorb capital at a scale that barely moves their portfolio but would drown a level 2 fund overnight. Global pension consortiums enter the same way, alongside insurance company general accounts looking for exactly the kind of long-duration, income-producing real estate exposure your platform now manufactures at scale. These allocators don't do site visits to 3 properties out of 40 anymore. They send teams that live in your data room for weeks, that fly to your regional offices, that interview your CFO and your compliance officer and your head of asset management separately, cross-checking answers for consistency the way federal investigators cross-check alibis. And somewhere in this range, without you fully noticing when it happened, you become a brand. Not in the influencer sense, nothing like Priya's barn. In the sense that people in the industry now have an opinion about your firm before they've ever spoken to you personally. You get mentioned in trade publications covering major transactions. Competing GPs reference your fund size when they're pitching against you, sometimes as a warning to their own LPs, sometimes as validation that the strategy category you both play in is real. Your name stops being attached to you personally and starts being attached to a track record spanning multiple cycles, multiple asset classes, multiple geographies, and that reputation becomes an asset on your balance sheet, even though no accountant will ever let you book it as one. The complexity underneath all of this is the part nobody warns you about when they're still dreaming about the AUM number. You're not running one team anymore, you're running a matrix. Regional heads overseeing geographic diversification because your portfolio now spans coasts and time zones and sometimes countries. A compliance department that used to be one person wearing 3 hats and is now a floor of its own, tracking regulatory requirements across every jurisdiction you touch, because a sovereign wealth fund's legal team will find the one filing gap in country B that nobody thought mattered when you expanded there 2 years ago. Reporting cadence stops being quarterly calls and annual meetings and becomes a permanent operation. Dashboards live updating for LPs who expect institutional-grade transparency on demand, not because they distrust you, but because at this size, distrust isn't the point. Governance is the product. Here's what actually separates the funds that break through $1 billion from the ones that stall out somewhere around $200 million, plateaued and stuck. It is almost never the deals. Plenty of funds stalling at $200 million have better returns than the ones that scale past $1 billion. What separates them is whether the founder built a platform or just built a bigger version of themselves. The funds that stall are the ones where every major decision, every LP relationship, every underwriting call still runs through one person's head because that person never let go of the machine they built at level 1. The funds that break through are the ones where the founder became replaceable inside their own firm by level 2, where the systems, the compliance infrastructure, the investment committee process all became bigger than any single person in the room. Sovereign wealth allocators can smell the difference in about 15 minutes of due diligence, and they will not write a $100 million check into a firm that collapses if one person gets hit by a bus. So here's the whole climb, compressed. Level 0 is you with nothing but conviction and a borrowed spreadsheet, calling everyone who'll pick up the phone. Level 1 is your first dentist, your first family office check, a completed cycle that proves the concept works at small scale. Level 2 is institutional capital walking through the door, audits, CFOs, asset managers, and the slow realization that the paperwork you built out of necessity is actually the product allocators are buying. Level 3 is sovereign wealth, multiple concurrent funds, a brand that precedes you into rooms you've never entered, and a platform complex enough that it survives you personally stepping back from any single decision. And here's the part almost nobody tells founders until they've already paid for the lesson. There is one structuring mistake made in the fund documents back at level 1 or level 2 that quietly costs platforms this size anywhere from 7 to 8 figures once institutional counsel finally finds it during level 3 due diligence, sometimes 18 to 24 months after it was written into the agreement and long after it should have been caught. It's sitting in the book linked in the description, along with the rest of this entire climb laid out in detail. Go read it before you write the clause that stalls you at $200 million.